Welcome to Startups and the Innovation Economy in 2023 with Stanford Angels and Entrepreneurs United. We're joined by Silicon Valley Bank's Lewis Howard today. Our group unites the Stanford startup community in innovation centers across the country beyond California with regular remote programming. Thanks for joining us. I'm Sheila Purvis, president of the group, managing partner of Primero Ventures and a Stanford engineering alumna. We're delighted to welcome Lewis Howard, head of startup banking at Silicon Valley Bank. Today's format will start with a speaker intro, followed by moderated questions addressing Lewis's view into 2023. Then we'll open up for audience Q&A, followed by closing thoughts. Note, this session is for educational purposes only and is not intended to constitute legal or financial advice to you in your specific situation. For such advice, please consult with your own legal, tax, financial, and other professional advisors. Lewis, could you please introduce yourself?
Yeah, thanks, Sheila. I love that you put the disclaimers in. Thank you, everyone. My name is Lewis Howard. I'm sitting here in our offices in San Francisco, California. Great to be with you all. Thanks for having me. As Sheila said, I'm the head of startup banking here at Silicon Valley Bank. SVB is the global leader in the banking for the innovation economy. We are around the globe, and we focus on 5 primary sectors: enterprise, consumer, frontier tech, fintech, and life science and healthcare. And we sit at the middle of that innovation economy, working with the companies and the individuals that start and work at those companies. And on the other side, all the funds and individuals that back and support and help those companies grow. So truly unique perspective from an industry of innovation, and excited and honored to be here today.
What does your crystal ball show for startups in 2023? Let's jump right in.
I love it. We go straight to the easy question. I think I depends on what you're building, depends on where you're at, depends on your stage and how much traction, right? If you classify and you look at startups that are later stage, we're seeing very severe decline in investment rounds, in valuations. And, if you think about it as somebody gave the analogy of it's a train crash, right? The impact happens at the public markets, and then it's going to take a while for the other cars to be impacted. And we've started to see all the way back at the very early stage cars be impacted, both from an investment perspective as well as a valuation perspective, and just pure traction. That being said, you asked about crystal ball in 2023. What is unique and different about this moment in time compared to other situations where we've seen global financial crises or tech sector corrections is the amount of capital that is in the innovation economy now is greater than it's ever been before, both in just pure dollars and size of companies that have been built, as well as capital that is in the form of dry powder that has been committed to the funds, as well as LPs who still have capital that they are actively deploying and looking for that outsized return, or even just a return that is diversified against a broader portfolio. So the amount of capital that is in this space is greater than it's ever been. And so while the headwinds are certainly here from where we see pace of investments, size of investments, traction on the company side, I believe that we will be able to weather this storm from an innovation economy. And there's no other place that I'd rather be than in the innovation economy to help those companies grow.
What's the expectation on sizes of fundraisers and the corresponding valuations, particularly at the pre-seed seed stages where you're at?
It's interesting. Again, no seed round is the same. I think it depends on some of the sectors that we're seeing have gotten hit much harder. If you look at consumer, if you look at some of the marketplace innovations, anything where there's discretionary spend, we're seeing a drop off in interest. Some of that I think is hyped by broader macro situations. We're still seeing quality deals get done there, but certainly not at the pace or the volume that we saw before. So it is sector dependent, where we have clean energy companies, you have enterprise software systems still at the pre-seed getting funded at a healthy amount. We haven't seen the drop off in valuation at the pre-seed and seed stage that we have if you go to Series B and A's, but B's and C's, we've seen anywhere from 20 to 50% drop in valuation. At the pre-seed and seed stage, we are not seeing that aggressive of a drop-off. We are seeing, I would say, minor, depending on the business. We're seeing upticks in valuations, but not as aggressive. What's happening, though, is typically those rounds are taking longer to close, and therefore companies are thinking differently about what's the overall amount that we are seeking to raise, where do we need to position ourselves from a available capital, and then how do you correlate that to growth? What does growth mean from a focus of your business, of the push of, well, do we go to profitability and massively slow growth, or do we keep growth at a premium and driving that? But that's going to come in at the expense of spending more cash. And so I think a lot of these companies are trying to figure out what's the right balance between reasonable growth, but doing so in a cash efficient manner.
How do you see evaluation metrics that companies are benchmarked against changing?
I think there's more focus now on true traction than there was over the last handful of years, right? I mean, you can go back and point to lots of times in history where it's like, oh yeah, they raised with not even a deck and it was an idea. Like, those deals are always going to happen. But I think on the whole, we're seeing far more interest and discipline on what is the business model, what is the traction that you are showing, how are you going to achieve the goals that you are setting out. You know, if you go to kind of more traditional enterprise metrics of, from a growth perspective, triple year over year, and then double, founders more and more are saying, well, back to what I was just saying previously, how do I get to triple if I don't have the capital to fuel it? Or do I need to build out more products in order to drive that? So we're seeing, I would say we're seeing it, I don't want to be totally categorical and say all of them are coming down, but I think we're seeing a lot more very reasonable conversations happen that say, okay, what is a reasonable growth metric for us to hit given the market that we're in, the situation that we're in? What are the levers and gears that we have to play with? Well, maybe your ACV is going to come down, but your total contracts is going to go up. Maybe you say, look, we're okay. We can stick with a longer sales cycle for a much larger enterprise contract. We're just going to have fewer, and you're going to run a different margin at that point.
Are you seeing the timeline of milestone expectations shifting at all? Still, you're raising roughly 18, 24 months out.
Timing of how much capital you should have, or timing of
how frequently you're raising?
Yeah, look, I mean, over the last couple of years when there was capital aplenty, we saw that kind of time between seed and A shrink in some situations as small as 4 to 5 to 6 months. That's returned to the 18 to 24 month time horizon that we historically saw, but there's exceptions to that across the board of outsized companies or really hot companies from a sector. We could debate whether or not they should be hot, but we are still seeing some of those outliers.
Digging into that point, which sectors and business models are you bullish on for 2023? And which ones do you find are way overinflated still?
I am bullish on companies that are truly solving problems. I mean, I think when I'll get more specific, but at an overall concept, right? We saw a lot of products, basically, not actually companies, or I spent X number of years at, usually less than 5 at some large tech company, and I saw this one very minute problem, and now I'm going to go build something that solves that problem. When there's a lot of capital running around, those we're able to raise, and some of them then are able to expand and use either PLG or other scenarios to expand. I'm less excited about those. I'm more excited about what are solving some true problems, and those problems that we're seeing a lot of interest in is around cybersecurity, around data, around upskilling and workforce support and services. Climate tech certainly is something that's not going away. Time horizons and business models in there have a bit of nuance, usually don't have something that starts making money straight out of the gate. But the interest from both the market and the LP ecosystem is there for things in the climate and environmental space. And then on the more kind of call it enterprise side, we still are seeing true solutions from a platform, lots of the data, lots of the infrastructure, those aspects and elements. It's probably impossible to get through one of these webinars without talking about crypto or Web3 or some of those things. I'm less bullish on that for the sake of doing that. We saw a lot of those models that were like, sure, we'll just slap Web3 on it, but there wasn't an actual use case. I think we are seeing companies that are building infrastructure in that space. Some like to call it Web 2.5, wherever you kind of want to land. I think we are still seeing interest in those, and the ones that are doing it smartly, I think will be successful. I still see a lot of talent going to truly build stuff that's amazing in that space. Flipping to the other side of the question, I think while I'm very intrigued by what the technology within AI as a broader realm can do. I think there's a lot of things that I'm seeing that don't actually have a business model and don't have a firm enough grasp of what that will look like in order to turn into a long-lasting going concern. There's going to be, again, point and use cases that I think are compelling, but that in and of itself is going to be hard to be a decacorn or whatever metric you want to hold yourself to.
Which startup areas or verticals are most and least impacted by the interest rate movements? And who could be second derivative winners or casualties?
I mean, I think we've seen a lot of turmoil in the broader fintech space. So anybody that has direct exposure to rate sensitivity, right? Prop tech and real estate tech, and will turn a little bit of cash into an ability to buy a house or some of those kinds of things. Those models, clearly, if you have a decline in home purchases, if you have rate sensitivity built into what it is that you're doing, that is very, very hard. So the direct exposure to that, I think lots of that is not just consumer fintech, but there's enterprise fintech as well that I would say falls into that. We saw a lot of these revenue-based lending platforms kind of jump out. You saw a lot of the raise debt to do roll-ups of Amazon web stores, things like that, where if you're relying on credit in a meaningful way to drive the business, it's going to be harder. Oh, sorry, what was the second part of your question?
Who might be second derivative beneficiaries or casualties?
There's always an eloquent word for it, but right now it's just escaping me, of like the inverse of globalization, right? Onshoring or whatever you want to call it. I think the groups that are figuring out how to do more localized, not spread it all out. You have less supply chain risk. You have less supply chain finance risk. I think there's interesting opportunities in both innovative financing models there, but also just when you're bringing it closer to the core, and companies are looking and saying, where are the areas that we have to twist some of those levers and gears when we know rates are here? Well, what if it's closer? What if we change the way our supply chain works? I think there's a huge opportunity there, and one that we'll continue to see in the onshoring or returning to a more not fully global, but half global, half local.
Help us out, Louis. Interest rates and scenario planning. Could you walk us through what happens if rates rise, flatline, or decline?
What happens if they rise or stay the same?
Yeah, or decline. How should founders and angel investors be thinking about this?
I'm not a public market investor. I'm a private market investor at the early stage. And as you said, not financial advice. The companies that I've seen be successful, there's a lot of elements and impacts, but two kind of primary things touching on your question. One is, how well do you actually know and understand your customer? And two, how well do you know and understand your unit economics? And I see a lot of founders that don't understand to the full extent one or the other, or in some cases both. As we talk about from the impact of rates overall, how that then applies to your customer is going to come into consideration, right? If you're an enterprise software sales enablement tool, what's happening from a budgetary perspective, what's happening from spend being brought in or tampered down, that's just from an overall cost of capital and availability of money. Yeah, you're going to have to modulate, but that also comes back to how well do you know your underlying customer. Then if you flip to how well do you know your unit economics, what impact, if any, right? Enterprise software is going to have a very different rate impact on their unit economics than perhaps a climate tech or a hardware company or somebody that is relying on actual acquisition of tangible goods to drive their business. And so really understanding what those impacts are, right? It's something that we, as a bank, we also build out scenario models until we're blue in the face. I thankfully am not the one that does that, but we have a lot of those conversations of what is the resultant impact on us, right? When rates go up, we also raise our MMA rates, right? We are wanting to provide and pass on that benefit to our customers, and that is great, but it also has an interest expense impact on who we are as a business overall. And so you kind of have to thread that needle of where do we play from a unit economics perspective as well as a bank, in the same way that any of these other companies would as well.
Some industry introspection now. What tactical changes are you seeing in venture funding?
It's interesting. I had a conversation last week with a an insurance provider to the startup industry. And one of the things that we were discussing is around truly understanding risk. Like everybody always throws out, oh, what are the risks? Well, there's risks that you can understand and quantify, and then there's risks that you can't. I think we are seeing more intentionality of understanding and quantifying risk and then taking that into consideration. Net for a lot of these things to change, the LP ecosystem is going to need to be the driver of whether that be on risk and diligence and the attention to detail that is taken there, or another topic that is very near and dear to my heart is around changing the landscape of diversity, equity, inclusion from a funding perspective, right? Until the LP ecosystem, who are really the ones that are controlling the dollars and cents, requires that level of accountability and transparency, both from a how are you doing diligence and what are you doing, but also from a DE&I perspective. We're going to have change, but we're not going to have the sea change that is required to truly address both of those things. And that has to come from the LP perspective and aspect. And so there's work that we're doing at SVB around that, but I think we need a whole lot more.
How attractive is venture debt for startups with the rates rising very quickly?
The thing that I always say about venture debt is it's always going to be cheaper than an equity round. And it's in particularly always going to be a lot cheaper than a panicked seed extension or oh gosh, we're running out of cash and now I'm going to go back with my hands out because I need an extra 4 months to get to my next milestone. And so, yes, while rates go up, the cost of venture debt is also going to go up, but the cost of that venture debt relative to the opportunity is what founders need to pay attention to. Pure play venture debt is designed to be that runway extender, right? It's intended to sit on top of your equity round to be used as necessary and as you see fit. But the most common use case that we see and we have is runway extension, right? So if we're confident as a company that we can raise that 18 to 24 months of equity necessary, now you ask yourself, okay, based upon our business model, based upon what we're trying to accomplish and what our needs are, would we be more comfortable having that runway extension to get us to, call it 36 months or 30 plus months? So you have that on the other side. Or we have other companies that say, look, we're going to be we're confident in our ability to raise, but we see venture debt that, okay, if we were going to raise 18 to 24 months of equity capital, what if we raised 20 and the delta is raised via debt? That's a lot less dilutive at the time of that raise to say, net, we're still getting the same amount of available capital that we can draw on, but we're doing so in a less dilutive manner. So playing that, you can squeeze the balloon in a bunch of different ways, but the understanding of what is needed for my business. Some people just want it as a safety blanket. Other people want it as a usable tool and product for them to fuel their growth. And that's kind of blanket venture debt in its pure play of what would be called a term loan for venture debt. Now, the larger you grow and the more complex your business needs are, we have product that is hardware as a service, that is, revenue lines for SaaS businesses. So like the more complex your business model, there's different kinds of debt, but your plain vanilla venture debt is typically a term loan structure.
You just mentioned risk management awareness is going up. So in that regard, does underwriting make it harder to raise venture debt now?
Short answer is I would say not really. We still look, right, if you look at venture debt and debt in particular, right, when you're underwriting debt, it is different than when you're diligencing and deciding to make an equity investment. Underwriting debt, you're looking at ability to repay, right? As a lender, I care about, can this company repay the money that I'm giving them with the risk-adjusted rate, right? And so the risk-adjusted rate can change based upon my perceived risk. But from an underwriting perspective, I'm still deciding, do I think they can repay me? And in venture debt, the sources of repayment, right? Best source of repayment is revenue because it's the cheapest, it's not dilutive, et cetera, et cetera. But if you're an early stage company, you may not have a whole lot of revenue. And so we'll use in traditional small business lending and underwriting, you're saying, I need 3 years of audited financials and I need to know consistently that the cash flow is there. And look, the more complex you get, we absolutely look at that. So don't take this as I'm saying we don't care about your cash flow. We care about cash flow. But at the early stage, we understand that a lot of these business models don't have the consistent cash flow for 3 years of audited financials. And so we look at what are the other sources of repayment. And the third leg of that stool is typically the venture dollars that you've raised. And so we look at who you've raised from, how much equity you have raised, who is in that syndicate, what sector are you in, to evaluate more of our risk-adjusted pricing, not necessarily have the underwriting goalposts changed.
What are other funding sources founders could consider besides venture capital and venture debt?
As I said before, the best is revenue, right? But we all know that's easier said than done. I've had a few of my own failed attempts at that. Certainly, well, and venture debt, I would say, is a very broad bucket of types of venture debt and what you're going to look at, right? We see a broad range of your, call it, cash flow smoothing products. So your enterprise, if I've got $750,000 contract, but it's paid, in annual installments, you can get a loan against that to give you more current cash flow to help that smoothing. So there's different types of debt that typically fall under this catch-all category of venture debt that we see. Some of those products at the later stage we offer. So revenue-based financing, customer acquisition financing for more. Now, I talked at the outset of some of the sectors that we're seeing struggle, e-commerce and some of those. Customer acquisition financing is a way that is non-dilutive. If for every dollar spent on your ads that you're going to get $250 back in a very repeatable and consistent way back to the sources of repayment, that's something that we can lend against that is non-dilutive. It's a little more business model specific, and if you look at fintech or other kind of platform for lending, your warehouse structures and facilities, that most of those are coming from other private debt funds until you reach a size and scale that we at SVB and other financial institutions can take those on.
Let's consider the perspective of different players. Should co-founders think any differently about cap table planning in their equity share leading into seed stage in this macroeconomic climate?
To clarify the question, think differently about how they divide it between the two of them?
Yes.
What they should pay attention to?
Yeah, especially if you're a founder starting out, you have some co-founder, how should you think about your cap table right now?
As a founder and or co-founder, wanting to preserve ownership is always top of mind. I think doing so in a realistic fashion is what matters. I've seen founders, and oftentimes that comes down to your relationship with your investors and the ones that are the leads and are setting those terms and pricing. And I would say in the headwinds that we face, it's fair to ask yourself, how much is this really worth? That's always going to be an investor. The tension between investor getting what they feel their ownership hurdle needs to be, you feeling like you have enough control and ability to drive that upside. I think that is always going to be the case. Some of the prevailing market conditions that are changing the conversations that I'm seeing, last handful of years, it was relatively common, if not, I wouldn't say everyone did it, but we saw a lot more founders taking money off the table at their Series A to do one of two things. One is just to cash out and give themselves a personal cushion. And so you have to ask yourself and your co-founder, are we going to do this? Are we comfortable with this? Are we going to set a limit or a rule? Where do we stand? If that's already how you're thinking about the A, you better have that conversation ahead of time. I don't see as much of that happening now. We're seeing A's are taking longer, scarcity of capital, et cetera, et cetera. But we did see situations where the taking money off the table at the A was done so that a lead investor, or in other cases, somebody who led the seed but was going to struggle to get actual pro rata in the A, the founder would sell so that the ownership levels could be squeezed by those who were leading out. I don't think we'll see as much of that. So the important dynamic of what are your reasonable ownership thresholds and what are you willing to give up in order to get to that position, always paying attention to that is important, but perhaps a little bit talking out of the other side of my mouth. I'd rather have a smaller sliver of a massive pie than own all of something that doesn't exist. So striking that balance there's not a specific formula. You asked about co-founder dynamics. Being aligned with your co-founder on that and those concepts is more important now than it's ever been. Slight plug that I'll throw in there is also pay attention to your structuring, right? Are you doing QSBS exemptions? Are you using, depending on your situation, are you using trusts? Are you using structures such that you are putting yourself in the best position possible, both personally, but also then from an alignment of the partnership with however many co-founders you have, of how does the scenario play out? If 2.5 years in, one of them decides that they're out, or, those are things that no founders in the early days ever want to say, like, well, what if I decide to quit in 2 years from now? But it's important to have those conversations so that everybody knows, because it's a lot harder to do down the road. Also something I've learned in a fund partnership. So you got to have the conversations ahead of time. Otherwise, it's always harder in the moment.
In light of labor market volatility, how should startup employees think about their options?
A couple of the themes that are very real, given the unfortunate situation of layoffs and what we're seeing in the market around options. One that oftentimes isn't talked about, and in some cases, employees don't know that this is negotiable, but negotiating your time horizon to exercise those is something that we saw less of, but it needs to be more and more part of the conversation of, in a layoff situation or in a changing of your location, the models of, hey, you can go get some credit to exercise your options. We're seeing those also dry up. So saying, hey, I need longer time to be able to go purchase those and deal with that is a lever that people have to play with. For a lot of folks, it depends on your personal situation, right? That balloon is always a balloon that you can squeeze. I'd like more cash, but is that realistic with what's going on in the market, with our raise, with the company's health? Or do I want to squeeze more towards the equity scenario and situation and take less from a cash-based comp perspective? So striking that balance it's hard to say as a categorical. It's going to come down a lot to lots of people's individual situations, right? Can I afford to take less cash but more upside if I believe in this company? Am I not in a position where I'm able to do that? And am I okay with understanding what I'm leaving on the table potentially in that way? What I find is most founders it depends on when you're joining, right? If you're in the early throes of it, having the transparent conversations matters. Oftentimes, if you're coming in later, might not have that ability, but at least understanding what everything in that agreement says and means and the impact that it has on you, that hopefully people are signing those knowing everything that's involved. And if not, you really should.
What should angel investors expect in this environment?
What I'm seeing from angel investors is those that have capital and have the conviction to deploy are getting phenomenal deals right now and are able to come in at a time where they are materially having an impact on these companies. They're like, hey, let me throw 10 grand at that because it sounds fun. Far less of that. So as an angel, what should you expect? In my opinion, you should probably expect fewer deals that you're going to be more involved with and you're super passionate about. Otherwise, you're going to get burnt, is the plain and simple statement of that. Spray and pray as an angel strategy never really works, but in a market constraint situation, it's even harder. Really committing to not just saying, yeah, here's some money, but having that conversation with the founder and saying, great, if all it is money, that's fine. Let's just be clear from the outset. Or are there other things? Or what are the ways? Is it product reviews? Is it introductions? Is it talent? Is it other things? You got to have that conversation with the founder so that everybody knows going in. I also, from an angel perspective, I'm not a fan of angels that take board seats just to say they're on boards. Good founders, in my opinion, in my experience, good founders will never want that. So if that's a mindset that you have going in because you think that's going to allow you to control more or to make sure your investment is safer, I would be skeptical of that assumption and understand the dynamics therein.
Louis, thanks so much for sharing your perspective so far. Now it's time for a live audience Q&A. So Louis, what are some salient market shifts that founders may be unaware of?
Access and availability of capital is becoming harder. I think the piece that is interesting, I was talking with a couple founders the other day of talent, right? But until a handful of months ago, there were top companies raising meaningful amounts from leading venture firms that would tell me we're writing 250 plus emails a day trying to hire engineers and not being able to hire them. That has changed, both unfortunately because of layoffs, but also just because of people are being more intentional about where they want to be and what they're doing. So I think the talent dynamics in this market will continue to shift. Second to maybe not even second, right? We talk about early stage companies. What do you need? You need access to capital, access to customers, and access to talent. Without those three, you're not going to build anything. So I think the talent piece is a big one. I think the customer piece, just going on those, the trends, the customer piece, it's feeling like it's harder to identify who those customers are and have those get to the full fruition, whether that be on the consumer side or that be on the enterprise, right? That goes back to how well do you know your customer and your market, and how well do you know your unit economics. I'm seeing a lot of, yeah, this will be our customer, or this is our addressable market, and that's not actually the case. And I think some of that is driven by purchase power, by the changes in macro markets, by just general, lots of folks sitting on their hands, unless it's in sectors where there's an immediate need and a pain being felt.
Do you have any advice for corporates accelerating collaboration with startups?
It depends on the stage. All right, this is something I tell a lot of our super early stage companies who say, yeah, I want to go sell to Cisco and Oracle and others across the board. And sure, you can begin those conversations, but typically those aren't going to happen straight out of the gate. And so sell to the series A, B, and C backed companies and build better product traction, a better product, and have the ability for when the time is right to be able to go sell into those large. So that's from a company up. I think from a corporate down, the biggest piece, and I would say we as an organization still have lots of room to learn and grow here, is being as transparent as you possibly can about what you're seeking and why you're doing that, right? Is this just a fact-finding mission to say, hey, what's going on out in the space? Or is it we have a very specific pain point that we are seeking to solve, and we think that we're going to go on a hunt for companies that can solve that. I see a lot of, call it looky-loos, or we think we're going to go hang out with startups because it's going to give us a glimpse into the innovation space. Most of those end up being a waste of time, and the companies that are going to show up and give you their time aren't going to be the ones that are truly having the right finger on the pulse of what it is that you're looking for. So being as specific as you possibly can and as transparent as you possibly can is the best way that I've seen the corporates that are doing it successfully get to the places that they need and want.
Another question here, what structural changes are you seeing in the industry itself? For example, what happened with Assure, an SPV service provider that's closing shop at the end of the year?
I don't know the specifics of the Assure deal itself to speak to that, but I do think that, similar to some of my statements from an angel perspective, I think a lot of people got way too far ahead of their skis from hey, this SPV looks great, let's throw dollars at it, or hey, this there, and they're not doing the research, or they're just following on somebody from a reputation or a perspective that they should have done more research and analysis. I think on the flip side of that, from a structural standpoint, people putting leverage against SPVs, people putting leverage against management fees and or future uncertainties from SPVs, that was never a good idea, in my opinion. And so, again, I can't speak specifically to the Assure situation because I don't have enough details. I don't have any details. But I think when everything's up and to the right and everybody's just trying to jump onto that train, there's a lot of sloppy decisions that get made. And then when the train slows down or has that collision that I described, then guess what? Things are going to get rough. While I am certainly all for democratization of access and agency, I think the agency piece is something that is incredibly important around education, around understanding the full ramifications, around structural things that can be put in place to actually have agency. Because just saying, sure, come one, come all from a democratization of access, if you don't have the agency piece, you're only scratching the surface and people are going to get hurt.
You started touching on this a bit earlier, but could you be more specific on which sectors will have a meaningful or a noticeable impact to their valuations and which ones are maybe a bit more resilient?
If I had the crystal ball, I'd go deploy capital in other places. But look, we're seeing a lot in the cybersecurity from a resilient, right? Some of the things that are core basic needs that aren't going away and rarely fall out of the nice to have discretionary spend bucket. So your core data infrastructure, your core security infrastructure. We saw a lot in the core payments infrastructure. I think there's still a lot of innovation and work that can and will be done there. I think touching on the talent aspect that you asked about before, so true platforms that do upskilling, true platforms that look at retention and that look at employee quality and strength. I think we're going to continue to see a lot there, from maybe less in the purchasers being the big tech companies, but that technology starting to branch into more traditional industries, because employee turnover is a massive, massive expense and headache, and training and upskilling internally is a huge component of that. Probably here's some personal bias of just things that solve real problems I care about a whole lot more than the unnecessary or the meal delivery apps or the Me Too's of some of those kinds of situations. But it goes back to whose problem are you solving and what is their willingness to pay for that kind of a problem?
We have a question here about angel investing. Again, what's the lowest personal net worth you should have to start as an angel investor in the early stages? And what are some of the biggest mistakes newbies make?
I don't have a specific number, right? A 1 million or a 100,000 or a 10 million.
Well, there's the SEC definition of accredited investor, I suppose.
Well, an accredited investor is 250K of annual income and a net worth of $1 million. That includes your home, though. And so from an angel investing perspective in particular, I look at it in answering this question is like, what's your affordable loss? And it touches on what some of the biggest mistakes is. Angels who view this as a sure thing and well, I gave you my money and now I need it back. Hopefully, if you're reading enough and you're diving into it, you're more sophisticated to know like, they don't have to give you anything back from a true angel investing perspective. You can structure it differently, but that takes a lot more time, energy, and effort, but they don't have to give you anything back. So what is your affordable loss given your personal situations and needs, right? And that's why it's impossible to say, here's the specific number, because everybody's going to have a different affordable loss threshold based upon their life, right? Do you have a high expense load? Do you have a high debt load? Like, what is that from a servicing capability? Because it truly is the most illiquid form of an investment that you can find in our space. Biggest mistakes, I touched on some of those before. I see a lot of investors who write a, relatively speaking, very small check and think that it gives them access and privileges and unfettered dialogue with the founder, when the founder's job is really he or she needs to go build the company. And so I see a lot of early and first-time angel investors. Typically, it correlates back to what's your affordable loss. Is you're nervous about the affordable loss potential, and so you think you're diving in to add a bunch of value and do a bunch of things, but you're not listening to the founder and saying, what do you actually need? And if you just need my money and you need me to shut up, then great, send me an update every month or every quarter or whatever that cadence is. Or, hey, I want you to participate in this round because I need access to your network or your expertise or your what have you. That's important to understand on your way in. Some of my best angel investments are ones that I rarely talk to. And I love that because it's less work that I have to do, but those are harder to find.
Thanks very much, Louis. That was a lot of ground to cover.
Yeah. Thank you.
So final question for you. What parting words do you have for us?
Look, I think I'll touch on a couple of themes. My mantra for my team at the start of 2022 was do less better and have more fun. I try to use those as guideposts in life as well as work. So I would say that. This is going to sound cliche and cheesy, but we're in turbulent times that none of us have ever experienced before in the exact same way, shape, form. And so extend grace wherever possible. Technical within this space, extend grace if it is one of those angel investments that you've made and they're struggling or they're flying and off to the up and to the right and you haven't heard from them. Like, extend grace, be kind. These sounds very, very cheesy, but there's a lot happening in our personal families within our bank, and we just need to extend that grace and be kind and know that these always happen and we'll come out the other side. We might not look the same way that we did going in, but this too will pass. I can't call the exact date or time that it will pass, but this too will pass. Likely, if you ask me, sometime towards the tail end of 2023, but don't quote me on that. But in the meantime, hang in there. Let me know how I can help. I'll put my email address in here, but let me know how I can help any and everyone. And thanks for the time.
Thanks very much for ending on a high note. That was Louis Hauer, head of startup banking at Silicon Valley Bank. Thanks for joining us again today. We truly appreciate your time and insight.
Thank you, everyone.